Hi, I'm Jerry Slusowitz, host of this Money Talks videocast. Today is Wednesday, January 25th, my daughter Sierra's birthday. Happy birthday, Sierra. Want to update you on the markets. We're trying to do these a little bit more frequently as of late. Today was a pretty big day on the market. I knew that Chairman Ben Bernanke, with his Federal Reserve meeting and announcement, was going to have more of an impact on the market than the President did with his State of the Union address last night. Matter of fact, the markets opened down around 80 points this morning on the Dow and was down maybe 60 points before the Fed came out with their blockbuster announcement that said they're going to keep interest rates on hold at these extraordinarily low levels. They moved it out from what was originally mid-2013 to the end of 2014. Now, if you missed it at the beginning, today's January 25th, 2012, and they're saying the end of 2014. So that's 2012, 2013, 2014 for those using higher math, counting at home. So it's partially in an effort to prove that they have a bigger printing press than the ECB, the European Central Bank. The ECB, through some of the operations, have been bailing out some of the banks over in Europe and in an offhanded way using the bank money to bail out some of the sovereigns there in Greece, Italy, Portugal, Spain, and Ireland. But this is really something. I'm still working on getting my arms around it. Is it that things are that bad that they realize it's going to take that long to absorb the unemployment rate, the housing market, to keep interest rates low on the housing market, that they are forced to say for the next 3 years we're going to keep interest rates that low? Sure had an impact on the markets. Like the quantitative easing, this is like quantitative easing 2.5. The Fed's going to continue to print money, going to continue to keep interest rates low. Remember, interest rates is the cost of money. If you need money, the rate you pay is your cost. They want to keep interest rates low as we get through these problems. I was somewhat surprised that came out today. The markets were down quite a bit, and it looked like we were kind of up against resistance. If you looked at last year's high and where we were over the last few days, the market looked like it was starting to roll over, but that now has been taken care of as this liquidity, the Fed money injection, will probably continue to drive the market higher. Now, we're very long in the markets. But what we've seen today as a result was gold broke out, silver kind of broke out late last week, and long bonds actually went down. Why would that combination happen? Could be inflation. It could be that commodity inflation and long-term inflation at some point is going to perk its head and it's going to be rampant and run away. And those asset classes, because the Fed could only control short bonds, long bonds would be negative if it sees inflation. We certainly see commodity inflation with the cost of gasoline, heating oil, the food certainly across the globe in particular, looking at those items. So again, we proved once again that we've got a bigger printing press. The Fed's going to be accommodative. It's good for bullish investors. That's a good thing. It should keep the markets, the greases liquid, so they can keep sliding along here and push the can down the road a little bit further. But it was a big news. It was a big news announcement. Did not expect that. I'll be honest with you. But we were positioned long, and we are short treasuries. So if you've got any questions about your portfolio, give me a call. Jerry Slusowitz. I've got 25 years professional money management experience. It is an absolutely free, no obligation portfolio review. Work on having a worry-free retirement for you. Call 800-449-9501. That's 800-449-9501. Or on the web, www.yourmoneytalks.com. We'll update you soon as we get a little bit more in depth with this analysis and what we think is going to be the outcome. But it looks like long-term inflation will continue to grow, and the Fed's going to keep the sugar going for the markets to keep rocking and rolling a little bit higher from here, which is good for bullish investors. Have a good time investing.